If you've been looking into real estate investing, you've probably heard of the term DSCR thrown around, but most people don't actually understand what it is, who it's for, and when it makes sense. Today in this video, I'm going to break down what is a DSCR loan, who it's great for, who should avoid it, the pros and cons, and how lenders calculate DSCR step by step. By the end of this video, you'll know whether a DSCR loan fits your investing strategy or if you should be looking at something else. Let's start off by understanding what is a DSCR loan in simple terms. DSCR stands for Debt Service Coverage Ratio, and I know that sounds complicated, but really the idea is simple. A DSCR loan is a rental loan where the lender cares more about the property's income than your personal income. Instead of asking where do you work, how much do you make, and how long you've had your job, they ask one main question. Does the rent cover the expenses? If the property pays for itself, the lender is going to be interested. That's why many investors call DSCR loans easy loans, because they remove a huge amount of paperwork compared to traditional financing. So why exactly are these DSCR loans so popular? If you've ever financed a rental property through traditional means, you know how painful underwriting can be. They're going to ask for tax returns, W-2s, and in-depth verifications for deposits in your bank statements, and endless follow-ups. With DSCR loans, much of that disappears. Lenders are going to primarily look at your credit score, the loan to value, the rent on the property, and that's it. This makes DSCR loans especially attractive for self-employed investors, new investors without long income history, investors who want to scale, and really anyone who wants simpler financing. This is something important to note though, that DSCR loans are not standardized. Unlike conventional loans, DSCR loans do not have national underwriting rules. This means that every lender has slightly different guidelines, rates may vary widely, and LTV limits may vary, along with their DSCR requirements varying as well. This is why shopping lenders matters more with DSCR loans than almost any other product. One lender may deny your deal, another lender might approve it easily. And now let's look at the down payments, rates, and prepay penalties of these loans. And here's what you'll typically see with DSCR loans. For purchases, it's usually 20% down. Some lenders might require 25% depending on the deal. With refinances, specifically rate and term, typically you're looking at up to 80% LTV, and cash outs are going to be limited at around 70 to 75%. And as far as interest rates, it's going to vary drastically. So it may be very different today than when you're watching this video, but generally it's about 1% to 1.5% higher than conventional. The next thing we'll talk about is prepayment penalties, which are very common in DSCR. They're usually around 3 to 5 years, either fixed prepayment or declining. And this applies even if you sell or refinance early. This is a major difference from conventional loans and something you really must understand before applying for DSCR financing. Let's talk about the biggest pros of DSCR loans. You don't need any personal income verification. There's no W-2 requirement, no 2-year self-employment history requirements. Properties can be held in LLCs or corporations. Multi-state portfolios are allowed. You don't need to be within the state to buy. There's less paperwork, and the closings are generally faster. For many investors, this makes DSCR loans one of the easiest ways to scale. Now let's talk about the cons of DSCR loans, because with any product, there's pros and cons. One, it's going to be higher interest rates than conventional, which is given. There are those prepayment penalties that we spoke about. LTV is going to be lower than what you generally can get through conventional loans, and the cash flow matters more than the appreciation, which is a big differentiator between fix and flip loans. So these DSCR loans work best when the property strongly cash flows. The next thing we're going to look at is how DSCR is calculated step by step. Let's walk through a simple example. All right, so let's go through a real world example. And so DSCR is going to look at the PITIA in accordance to the rent that comes in. The PITIA stands for the principal, interest, taxes, insurance, and association fees, if there are any. And then that is divided by the rent, and that's how we get the DSCR ratio. And so looking at this, let's say we have an example where the principal and interest of the mortgage equals $1,000 for the P and I. Taxes were worth, let's say, $150 a month. And the insurance right here, let's say another $150, and association fees, if any, say $50. And then compare that to the rent of $1,800. $1,800 for the rent. So now what we're going to do is we're going to tally up our PITIA in comparison to our rent. So $1,000 for the principal and interest, $150 for the taxes, $150 for the insurance costs, and $50 for the association. So that means that we have a total of $1,350 $1,250 monthly principal, interest, taxes, insurance association, PITIA, in comparison to $1,800 that you're making on your rent. So now we're going to take that $1,800 divided by $1,350, and we're left with a 1.33 DSCR ratio. And this means that it's cash flow positive. The minimum DSCR requirements that lenders want to see is a 1.00. But as far as the lender's requirements, a 1 DSCR is a lender bare minimum. With better rates available, typically if you have a maybe 1.1 or 1.15 DSCR ratio. But looking at this deal, this would be a very healthy cash flow margin and a deal that a DSCR lender would likely accept. So that's the entire calculation. No tax returns, no income docs, no employment verification. These DSCR loans work extremely well with this BRRRR method. BRRRR stands for buy, rehab, rent, refinance, and then repeat. Let's say you buy a property at 75% or less of ARV. You can often use the hard money to buy and rehab the loan, refinance it into a DSCR, and then most times leave little to no money in the deal. So you can pull money out and oftentimes repeat it and roll it into the next deal. This is one of the most powerful ways investors can scale rental portfolios. A question that gets asked a lot is, can DSCR loans be used for short-term rentals like Airbnb? And the answer is yes. DSCR loans can be used for Airbnbs, but there's a catch. If the property doesn't have well-established short-term rental history, lenders will often ignore the Airbnb income, use long-term market rents instead, and this can reduce your qualifying loan amount, especially if the loan only made sense using short-term rental data. Some investors solve this by starting as a long-term rental and then refinancing later and converting to short-term after a seasoning period. And so it's really just about doing your research to finding those lenders. So in conclusion, DSCR loans, they're not perfect, but they are incredibly powerful when used correctly. They're ideal if you want simple financing, you don't want to deal with income verification, you're building a portfolio, and these properties are cash flowing. If you understand the numbers, shop lenders properly, and stay disciplined, DSCR lenders will definitely help you grow faster with less friction. And again, if you have any questions or want help evaluating whether DSCR fits your situation, feel free to reach out. And if you're ready to apply for a DSCR loan, go ahead and click the link in the description and we'd love to help you out. Thanks for watching, and I'll see you in the next video.